Welcome to Cherry Street Investor Education with Kavita Baratake, passive income coach and founder of Cherry Street Investments. Education that is designed for you to take control of your financial life. Join us to learn how you can create multiple passive income streams, diversify your portfolio, save on your taxes, and much more. Become a better investor and fast track your financial goals. Here's your host, Kavita Baratake.
Good evening, everyone, and thank you for joining our webinar on creating tax-free retirement income with the mega Backdoor Roth. I'm excited to host Bernard on this webinar because I've gotten some amazing feedback from him, from others in the industry, and I've heard him on podcasts and a lot of places, and I'm excited to bring him on to here because he's one of those people who brings in pure information and knowledge and not focused on the sales aspects of things, which I love doing, as you guys know, with my webinars. So I'm really excited to have him on. And he's also very knowledgeable in this area of retirement, as well as being a CPA. And I don't even know what all those acronyms mean. So I just cut and pasted from LinkedIn, but I'll let Bernard introduce himself to you guys. So before we get into that, I wanted to talk a little bit about this topic and why this is so something that you guys should always think about. Is a couple of questions I want you all to think about is one, do you think the taxes will go down in the future? Two, do you think maxing out your pre-tax 401k account is always a good idea? And there are cases when it's a good idea, but is it always a good idea? And three, are you creating a retirement income that is tax-free? Not just the pre-tax dollars, right? Those three things are things I want you to think about as we walk through this presentation with Bernard. I believe strongly that while it's important to save on taxes today, the problem is most people assume that they're somehow magically going to be in a lower tax bracket in retirement. I sure don't want to retire poor or retire with less money than I'm making right now or a worse standard of living, and I hope you don't as well. So I want you to all learn, and I want to learn as well, how and why to create that tax-free retirement bucket in addition to all the other sources of retirement funding that you have. Bernard, as you know, and it's Reisz, Bernard Reisz, is a retirement account guru, CPA, and founder of ReSure, who will walk through the mega Backdoor Roth strategies. Some of the learnings that you will walk away from this webinar is understand what tax-free money is and how it can 10x your wealth, how your boring 401k and QRP can be transformed into a very powerful tax weapon. And if it's all too good to be true, are there IRS compliance risks with this tax strategy? So we'll talk about this with Bernard today. Before I hand this off to Bernard, a quick disclaimer as always. Always consult your attorney, financial advisors, CPA for your specific situation because all these webinars are meant to be educational. They don't address your specific situation. You can always set up a call with Bernard, who's a CPA, to discuss your own specific situation and take his services or use his services, but don't assume that everything we talk about always applies to you. So a few housekeeping items, please ask your questions in the Q&A box located right now because I find it really hard when the chat box is scrolling with questions. So we want to make sure we don't lose your question and we get to it at the end of the discussion. So we will answer questions at the end of the discussion just to keep us on time and to cover all the things that Bernard hasn't stored for us today. Always, I get a lot of emails about this. Will this webinar be recorded? Yes, it will be recorded. And usually you'll get a note, you'll get a link to the webinar by Friday morning. Since it's Wednesday, I'll have it Friday morning. Please whitelist my email so it can come to the right inbox. So a few upcoming webinars before I hand this off to Bernard. Please keep this in mind. A lot of folks that follow me are very interested in this whole idea of financial freedom and making maybe having a second profession or doing something else in their career because they have been in their current career for a very long time. So I keep that in mind when I design these webinars. I also think about retirement, tax planning, and all these other topics, and not just investing. Investing is just one piece of the puzzle as far as I'm concerned. So some of the upcoming webinars might be of interest to those of you who are looking to create that financial freedom, as well as looking for avenues to make their passion their purpose. So we have a Tony Robbins coach next week, actually in 2 weeks from now, talking about making your passion your purpose. That will be the first week of April. And following week, we'll talk about the nuts and bolts of how do you create a roadmap to financial freedom, which will jump into some of the numbers that you need to think about when you're thinking financial freedom. We'll also talk the 2 weeks from there. Usually I do this every 2 weeks on Thursdays at 7:30 Central. Sometimes I kind of have to reschedule depending on what else is going on. So we'll have a talk about short-term rentals. A lot of you are looking for how to generate more income from the single family properties or properties you might have. So we have a short-term rental expert coming. And also I do a lot of webinars, but I would love your feedback on future topics, because sometimes I really run out of topics. So I would love your feedback to keep this webinar thing going. Otherwise, I'll just bring whatever I think I want to learn about. So you guys, please give me your feedback, send me a note, good, bad, ugly. I like to hear it all. So a little bit about me for those of you new on the call. I am an immigrant from Bangalore. I moved here in '98. I have a master's, the usual Indian story, came here for my master's, never went back. I spent 20 years in tech as an engineer and a manager, and then moved into real estate. I actually started doing real estate while I was in tech, and then realized I love what I do, and I wanted to do it full time because I didn't want to juggle 3 different jobs. I'm also a single parent, so that was 4 different jobs. So I quit tech in 2019 after real estate helped me become financially independent, and I help other people do the same right now. I focus a lot on education for those of you who log in week after week for my webinars. Thank you so much. I appreciate you guys. I appreciate you taking time away from your families this late in the evening after a full day of work to come learn with us. I help people invest passively in real estate, as well as do high cash value insurance policies. And it's another story how I got into it, and I love it. This whole idea of infinite banking is what I do a lot of lately, besides real estate. For those of you who are looking for previous webinars or education, I do a lot of short videos, as well as post every single webinar that I've done in the last 2 years on this YouTube channel called Cherry Street Investor Education. Please subscribe to me so I can help propagate more knowledge about investments and all these other topics. And that'll really help me, not only help you get notified every time I upload a video, you'll get a notification if you're subscribed, but it'll also help me grow my channel and reach out to more people. And hopefully my goal is to free more people from their jobs. If you love your job, that's great. You know, your passion is already a purpose. But if you don't, then, you know, it's always good to learn. So you'll get auto notified on new uploads and content. I also have a Facebook investor group called Purely Passive. We are over 700 people strong, and I love for you to join us here. With that, I'm not going to waste any more time. Bernard has a lot of things in store. So Bernard, please introduce yourself and talk to us about Mega Backdoor Roth. I can't wait.
All right. Yeah. Looking forward to this. Honored to be here. Thank you for having me, Kavita. And can you pass over the screen share to me?
Yes, you should be able to share automatically, but I'll give you control as well.
All right.
I can stop the share.
Okay. Is that looking okay?
Yep.
All right, let's dive in, and I guess I'll give a very brief introduction, not to take away from the content. You're wondering what all those stand for. So those are actually insurance designations. CPCU is Chartered Property Casualty Underwriter. ARM is Associate in Risk Management. ACI is Associate in Captive Insurance. Now, all of these, though, come back to tax. So insurance is a big part of, there are a lot of advantages to insurance in the tax world. But rather than approaching things very superficially and kind of buying into it, you really have to understand the insurance side, not just the tax. You have to understand how insurance companies operate, insurance risk and risk management. So that's the approach that I bring to everything that I do, whether that be retirement accounts and any other financial tool. It's about really getting to the bottom of things, the substance, and avoiding kind of just grazing the surface. The way to help people is to have that deep and broad knowledge. And with that, looking forward to answering questions and discussing creating tax-free retirement income with Mega Backdoor Roth. So a good place to start, which is a little entertaining before getting into the details, is let's talk about some IRAs that are worth hundreds of millions of dollars. Because it's entertaining, it's interesting, but it also really emphasizes the power of Roth, where that really, really comes into play. So people have IRA accounts, and we know we can contribute annually to an IRA. It goes up incrementally, but suppose it's $6,000 per year, $6,500. If you have other types of accounts, you can put in more. But how do you get an IRA worth hundreds of millions of dollars? And think about how you would like to have, if you were able to grow your IRA to be hundreds of millions of dollars, what type of account would you like to have? Would you like that to be a Roth account or a traditional IRA? So some examples: Peter Thiel owned millions of shares of PayPal through his Roth IRA. Same for Facebook shares that were purchased pre-IPO. Max Levchin has an IRA worth hundreds of millions. He held millions of shares of Yelp in his Roth IRA. On the opposite side, we've got who did it wrong. And we put the wrong in parentheses because he's got sophisticated and savvy financial people. So who's to know what he's really got up his sleeve? But Mitt Romney has an SEP IRA, which is a pre-tax traditional IRA worth hundreds of millions of dollars. And the speculation is he invested in Bain Capital's private equity transactions with his SEP IRA, getting the carried interest and catapulting that to being worth hundreds of millions of dollars. So if I can pose a question to the audience, where would you want to have that IRA? If you had an IRA that you managed to grow 100,000x or a million X, would you want that to be a traditional IRA or a Roth IRA? Awesome. Okay. So definitely Roth, and that's because, as we know, the Roth IRA is tax-free money. The SEP IRA, which is essentially a traditional IRA tied to a business, is pre-tax. So if Mitt Romney has a SEP IRA with $300 million in it, considering the tax bracket that he's probably in, and regardless of which tax bracket it's in, there are going to be RMDs on that. It's going to have to be distributed in huge chunks, putting him in the highest income tax brackets, even if he wasn't. And he has a partner in all that money. So the IRS is Mitt Romney's partner. So if he's got $300 million in there, listen, he's got a partner, a very prominent partner. Perhaps we can say we're all partners with Mitt Romney, because if Uncle Sam gets his hands on that money and puts it to good use, it's Uncle Sam represents us to a certain extent. So we are all partners in Mitt Romney's SEP IRA, if that makes anybody feel good. But this really highlights the power of Roth. And in scenarios like this, it's really clear that Roth is the right way to go. Of course, as we're going to progress into this presentation, we'll see that it's not always clear But this kind of contrast brings home the point. Now, one of the things to digress before diving into the meat again is, does the rule make things as simple as possible, but no simpler in the financial world and the tax world, in order to sell things and present them to retail investors and move products, so to speak? The financial industry tends to oversimplify, and kudos to Kavita to putting on these webinars and to try to move away from that oversimplification. But of course, we're not going to be able to capture everything. We'll try to get into some of the details and answer some of the complex questions. I can see already that the audience is an educated audience with substantive questions. And a word on tax strategy. Approach tax strategy the same way you do an investment. So that's both in gauging the ROI, right? Every tax play has an ROI, which is in the tax savings, but there may be risk associated with that. You have to gauge the risk, and combining the risk and the reward, you arrive at your risk-adjusted return on the strategy. And in order, just like an investment requires due diligence. And when you look at it presented with a real estate syndicated deal to invest in passively, you'll do due diligence, or should be doing due diligence, on two things: both the deal sponsor, the syndicator, and the deal itself. So anytime you're presented with a tax tool or a tax strategy, you should be doing due diligence to see the substance of the offer. Because remember, every tax tool or every tax strategy is just like an investment with ROI. So is the pro forma that you're being presented, is that realistic? Does it hold up to scrutiny? And then obviously, what's the track record? Who is presenting it? Do they have a background that would make them qualified to work in the tax space, or are they just a glorified salesperson? So approach tax the same way you do an investment. And what emerges from that is sometimes some people are presented with a tax strategy that has some gray, and they shy away from it because there's a trace of risk. But when you do like an investment and you recognize that an investment always has an element of risk, and a tax strategy may have an element of risk to it, but when it's put into context, you're able to embrace it and pursue it. And in most cases, you're going to get the ROI that you're actually seeking if you performed the appropriate due diligence. We're going to be talking about retirement plans and a specific focus on qualified retirement plans. But of course, not everybody, when working with qualified retirement plans, we're being hyper-focused on a specific strategy, but actually selecting, implementing, and operating the correct plan for any individual has a lot of nuance to it. And so this is just going to assume that you are able to set up or have in place the proper plan to execute these strategies. Now, we spoke about the extreme cases of IRAs that are worth hundreds of millions of dollars. But there are other reasons why you want to always be focusing on your traditional, your pre-tax buckets and your Roth buckets. And that's because, again, coming back to that investment theme, just like investment in investing, there's a concept of diversification, whether you pursue that or not. Some folks go all in, some folks choose to diversify. Each approach is great, so long as we're making informed choices. In taxes, it's the same kind of thing. And Mr. Biden is bringing that home right now. So when you use tax sheltered vehicles, what that gives you is different buckets and the flexibility to tap different tax buckets at different times. So you may use a pre-tax account at some point, take the tax deduction when the tax deduction is valuable to you, do some sort of Roth conversion or Roth contributions when the time is right. And you can always choose when to recognize that income. So changes in tax code bring home the power and the value of diversifying your tax buckets. If real estate takes a hit in its tax treatment, you may be able to tap tax advantaged funds to carry you over while you navigate these tax changes, which hopefully will not happen. But they do remain a possibility. And I do think Kavita did an education program on these proposed changes. So any questions? We're going to dive in more into the nitty gritty. But any questions at this point, pop them in the Q&A. And we definitely look forward to answering them. If they relate to a particular slide, we'll try to answer it as we go through that slide. So retirement accounts 101 in terms of how are traditional dollars taxed and how are Roth dollars taxed. On the traditional side, you get an upfront tax deduction. So if you put $10,000 into the retirement account, your taxable income for the year is reduced by $10,000. What's the value of that tax deduction? Well, it's going to be a function of your marginal income tax rate, combined state and federal. So if you're combined 40% state and federal, your initial savings on that $10,000 contribution is going to be $4,000. But now the great power of that is that you get to grow that money for many, many decades potentially. You can even have this for your children. So children can have it theoretically, but of course children are going to be better off on the Roth side. But for 60 years of tax-free compounding is extremely powerful. And then of course, on the back end, if you happen to be in a lower tax rate when you pull it out, or when you do the Roth conversion, you have a real tax arbitrage, and you can put the money in when you're in the 40% tax bracket and do the conversion or pull it out when you're in a lower tax bracket. So it's tax deferred. The true outcome you'll only know when you actually pull the money out. Okay. Raj, see the questions. Kang, see the question. We will definitely get to those. And that's going to be part of what we're going to be discussing today. Roth, in contrast, there's no upfront tax deduction. It's included in income, but that money is forever tax-free. Unless, of course, you encounter UBIT, which is a subject for a different time. But fundamentally, that money is tax-free forever. So the choices we're faced with are trying to choose, where do we want our funds to go? Do we want our funds to take the upfront tax deduction, tax deferral, kick that can down the road? Or do we want to pay the tax and kind of buy out our partner, essentially? Kick the IRS out of your retirement account and keep that money tax-free so that all that growth is yours and your heirs without having to share any of it with Uncle Sam. What are the factors to consider? So there are more than we can possibly address here, and Kavita touched on some of these during the introduction, but it's going to vary from individual to individual. You're going to be looking at what's the value of your current tax deduction. What are your expectations regarding future taxation, which means your future level of taxable income. And it doesn't mean necessarily your level of taxable income when you retire. It can be your level of taxable income when you go on sabbatical, which may present an opportunity to do a Roth conversion. And what are your expectations about future tax rates? And Mr. Biden is bringing that point home very emphatically right now, that this is something we've got to think about. And lastly, you've got to think about the nature of the investment strategy. And so investments with asymmetrical risk reward, with asymmetrical payoffs, are very well suited to Roth accounts. So the kind of investment where your downside is a few $1,000s, but your upside is PayPal or Yelp belongs in a Roth, right? So when is Roth a clear winner? When you have that asymmetrical payoff, go with Roth, because if you want those hundreds of millions of dollars, or not even bring it up that high, but if it's tens of millions or millions, you want that to be tax-free. You pay the tax on the $10,000 up front, and this way you get that payoff. Now, nobody's got a crystal ball, so ultimately it's about your personal situation, figuring out and projecting out your assumptions, your investment thesis, and reaching conclusions based on that. Of course, nobody's got a crystal ball. Where are tax rates going? We don't know. We do know perhaps that Biden will raise them, but they may come back down. Tax rates were supposed to have gone up a long time ago if we'd follow, what many of the pundits say. So we really don't know. There is an element of certainty to this. So what is the mega backdoor Roth? So those are, I'm guessing this audience is familiar with the backdoor Roth, which is a way of making Roth contributions for those that exceed the income limit for making direct Roth contributions. So you funnel your money through a traditional IRA and then convert it to a Roth IRA. But that's a very limited strategy because the contribution limits to IRAs are quite low. And so certainly for folks that are phased out because they're at higher income limits, the IRA contribution limits are not particularly meaningful. So mega backdoor Roth is about at a minimum 10xing your Roth contributions and potentially 20xing them, depending how you're structured and what's available to you. So the goal is to take the full annual contribution limits, annual additions limit to a qualified plan, which those are called among industry professionals, or those are called the 415 limits, which are currently $58,000 plus catch-up contributions for age 50 or older. So you're looking at about $65,000 potentially that can be converted to Roth per participant. So create that 65K up to 65K or perhaps 130K in Roth money, invest and grow that 100x, 1000x, and then pull all that money out completely tax-free. So what are the steps to actually doing that? So as we go through the slides, we'll get further and further into the detail, but at a high level, contribute the max amount to QRP 401k. QRP stands for Qualified Retirement Plan. That is an umbrella term to refer to a group of plans under the tax code. And there are a whole bunch of plans that fall under that rubric. Take all that money, either roll it out of the plan into a Roth IRA, or within the plan, do an in-plan Roth rollover, also known as an in-plan conversion, thereby creating that $65,000 of tax-free money.
Hey, Bernard, just to kind of interject here, I think a lot of the W-2 folks on here might be a little bit confused. I know a lot of them haven't heard about the solo or QRP. So could you just tell them a little bit about how that kind of account can be set up? Because they still have the 401k limits that they're set by their employer and on the regular employer account. So can you just briefly allude to that?
Yeah, glad to. So the term QRP, which many people don't recognize, but when it's explained, everybody sees and knows exactly what that is. QRP stands for Qualified Retirement Plan. Easier to say QRP, just like nobody says individual retirement arrangement for IRA. And if you've got a 401k plan, which you likely do, That is a classic example of a QRP. Other examples would be 403, 403B, 457, and then you have defined benefit plans, cash balance plans. So there's really nothing mystical about QRP. It's just an easy term to use to refer to that group of plans that are distinguished from IRAs. Now, the strategies that we're going to discuss and discussing can theoretically be executed in a qualified retirement plan that you have through your employer. In practice, it's not so likely that you'll be able to execute it there, and you'll need your own qualified plan. So when the term QRP is used, or solo 401k, this terminology is often used to refer to a plan that you create for a business that you own and operate. Now, that gives you, having your own business gives you the flexibility to craft a plan according to your objectives. If you have employees, that can, as we'll see, that can constrain some of the things that you can do because of 401k testing requirements. There's some ACP testing, ADP testing, but theoretically, these can be done in any plan, provided you have the ability to craft and customize that plan to your desires, which you likely don't have with your employer-provided plan. There's been an avalanche of misleading information about some of these topics. So whether or not you will be a good fit for creating your own QRP is something that very often requires very, very careful analysis. Number one, to know whether or not you actually qualify. Number two, to know whether or not there are you have employees. And sometimes people think, hey, I don't have employees, but there are very complex rules called controlled group rules, affiliated services group rules, and ownership attribution rules that lead many people to actually have employees for qualified plan purposes without realizing it. So anytime you enter the QRP world, the 401k world, you need to work with people that are aware of all the nuances and want to spend the time and share that expertise with you, not just sell you a plan document. But we'll see, and hopefully you'll have these options, the mega backdoor, in the plan that you have access to. And of course, you can explore options to get access to the type of plan that's needed. So I think it behooves me to say that the availability of these tax strategies is not the determining factor for whether or not you can adopt your own 401k or QRP. The determining factors are going to be the factors that are used to assess that based on your tax profile. So, Kavita, has that provided adequate clarity, or do you want to chime in and provide any more context?
Yeah, I just want to say it from a perspective of a layperson. I think you said a lot of words there, which probably threw off a few people like me. So I'd say, for example, let's say I had an old 401k plan with an old employer that I was able to roll into a self-directed IRA or a solo 401k once I started my own business. So there are ways to take your old employer accounts and employ this strategy. Now, instead of a solo 401k, you could potentially set up a Roth. Is that right, Bernard? Just wanted to clarify that.
Exactly. So within these qualified plans that we're going to see, there are, in this slide, this is the perfect question for the slide that we're at. There are different buckets. There are 3 buckets created in a 401k plan. And I'm using 401k now interchangeably with 403B and 457. There is a pre-tax. And that's what most people are familiar with, which is the money that you put in and you get a tax deduction for that. So if you put in that $19,500, that's removed from your income. So if your salary was going to be $100,000, your W-2 in box 1 is not going to show that full 100,000. It's going to show 100,000 less 19,500 if you contribute the max to the pre-tax 401k contribution bucket. That's a tax. That's your tax deferred bucket, where you get the upfront tax deduction. Now, perhaps less well known, but I'd say second in terms of the types of buckets that investors are aware of, are Roth 401k contributions. So you can have a Roth bucket, and so that same $19,500, rather than claiming a tax deduction for it, you can designate that as a Roth 401k contribution. And you pay taxes on it, but it functions very much like a Roth IRA. The funds in that bucket are tax-free forever. So that's your Roth 401k. So using a Roth 401k, if your plan has it, and those are becoming more and more available, you can create the $19,500 by foregoing the tax deductions and designating your $19,500 contribution as a Roth contribution. But that still doesn't get us anywhere near the $60,000 in Roth that we're talking about. And so to reach that, we need to have an awareness of a third bucket, which is after-tax 401k. And after-tax is not synonymous with Roth 401k. These are occasionally used interchangeably, but in the qualified plan world or the tax professional world, these are two distinct terms. And after-tax 401k is maybe a nice thing to have, but it doesn't have all the benefits of a pre-tax nor all the benefits of a Roth. So after-tax is money that you put in for which you get no tax deduction and upon which you will pay taxes when distributed. The benefit of that bucket is that while it's in the plan and invested in the plan, no taxes are paid. So you're able to grow that money without the annual tax drag. So it's after tax, means you pay the taxes on the principal, but it's not Roth because when that money is removed from the plan, you will pay taxes on the growth that happened inside of the plan. Now, nobody really wants to have the after tax. You either want to be in the pre-tax or the Roth, but this bucket is the key to achieving mega backdoor Roth. So we keep mentioning that $19,500 limit. Well, that limit only applies to your Roth or your pre-tax. Theoretically, a plan can allow you to make after-tax 401k contributions up to the annual additions limit, which is $58,000, unless you're eligible for catch-up. So the after-tax is the key to getting $58,000 into the plan. So now understanding these buckets, these are the steps for hitting our Roth targets. Step 1, max out your non-deductible contributions up to the limits. Execute a in-plan conversion to the Roth. So that's another feature that the plan has to allow, it has to allow both the after-tax contribution up to the limit. It also has to allow that those amounts be converted to Roth. You execute that conversion, you've just created $58,000 in Roth money. And all you got to do, now the ball is in your park, invest those assets, grow at 1,000x, and keep that all tax-free forever. So these are the key concepts and the key steps. Kavita, before going further, and of course, let me know, about time limits. Any questions, anything you'd like to clarify, or any questions we should focus on?
There are a lot of questions coming up, but I think we can get them at the end just because I don't want to derail your conversation, but I think that's a great point. So I do have a question about the 58,000. Now, when I have a solo 401k, can I not make a pre-tax contribution to the solo 401k from my business up to 58,000 and not have it be after tax? Is that right?
So yes, that is doable, because it's a question of understanding how all the 401k limits work. So the 19,500 is what we call the employee limit. The 58,000, generally speaking, before our conversation about after-tax contributions, how else do you hit the 58,000? That is through employer contributions. So in a plan in which you're the business owner, so essentially you're getting a tax deduction for both sides. As the employee, you're taking the 19,500, and the difference between the 19,500, that delta, whatever you contribute above in that amount to hitting the 58,000, is a tax deduction to the business. So if you're the business owner, you're getting the benefit of $58,000 in tax deductions. So you can get to that 58, but it's a business tax deduction. It's not an employee tax deduction. Does that make things clear?
Totally makes sense. And honestly, from a Roth conversion standpoint, you want it to be after tax dollars anyway, because for a Roth, it needs to be after tax, right?
Exactly. So the way to go here, it comes down to plan design. There's just an infinite way plans can be designed. Ultimately, there's a lot of expertise that goes into plan design. The plan documents are generally, come with many options, and it's a question of selecting the correct options based on your tax profile, whether you have employees, don't have employees. And obviously for larger businesses, there are administrative constraints, cost constraints. It's not always about providing the greatest benefit to the employees. Very often it's about, limiting the expense to the business. So there are a lot of factors at play when you're not designing the plan for yourself, but it's rather being provided to you. Okay, so can this be done in a QRP? So I'm glad we spoke about QRP. And so everything that's on this slide, half of it should be very familiar. So yes, this absolutely can be done in 401k, 403b, and 457. Not currently available for TSP. If we've got any military folks on the line, they'll recognize TSP as a thrift savings plan. So theoretically, doable in any of these plans, but just because the IRS says it's theoretically allowed doesn't mean the plan will provide it. As we said, the plan's got to allow for after-tax contributions and the ability to either convert those or roll them out of the plan. Now, this sounds so great, as we said. So why doesn't every plan do this? It's amazing. The ability to create tax-free money. This sounds too good to be true. So the reality is that plans that cover employees have to pass annual non-discrimination testing. And if they fail that testing, there's a whole slew of potential repercussions. So it's got one of the tests that it's got to be passed is called the ACP test. And if after-tax contributions are made to the plan, even if it's a so-called safe harbor plan, it still has to pass ACP test. Without getting into the details, the likelihood of passing an ACP test is close to nil. So in plans that cover the business owner and employees, where there's a disparate level of income, where the business owner may be earning substantially more or have much more cash flow to for tax structuring, it's inevitably going to fail the ACP test. Secondly, allowing all these options in a plan provide an administrative burden. And so who's shouldering that burden? Whoever, if it's not you, if it's somebody else, they're not incentivized to provide all these options. So Kavita, I think before going on, should we elaborate about any of these topics? Or I think, this ACP test, and all this qualified plan nuance is best for a separate discussion. Suffice it to say that when you get a QRP, you don't just want a plan document. It's the plan operation that is crucial, determining if you have employees, and if you do in fact have employees, ensuring that you have the compliance support to operate it. Now, what will be the best fit for this? It's as Kavita mentioned, it's going to be a solo QRP or solo 401k. So that's a 401k that is not subject to annual non-discrimination testing because it only covers the business owners, and there are no non-owner employees that are eligible plan participants. So solo 401k plans have an incredible amount of complexity to them, but nowhere remotely near what an ERISA QRP has. So this is the place, though, where you drop all that non-discrimination testing and it becomes feasible to design the plan this way and execute the strategy. So I guess it's worth speaking about that for a moment. In order to adopt any type of qualified plan, the ABC of a qualified plan is that it is a trust set up for the benefit of employees or a self-employed individual. So what meets that determination? Sometimes it's obvious one way or the other. Sometimes it can be gray. We do not have any hard and fast rules, any bright line rules from the IRS about what constitutes a trade or business. In fact, it's been one of the most heavily litigated areas as it applies to many areas of tax, determining what is a trade or business. So there's lots of case law about it. For certain areas of taxation, the IRS has provided some measure of guidance. Ultimately, it's one of those things where it's a facts and circumstances. So you've got to have a trade or business in order to adopt your own qualified plan. And then this second step of the analysis is, are there anybody else that should be included in that plan? Because you may think, and I've seen this posted on all sorts of social media, Facebook and LinkedIn, just create a consulting business and you don't have to cover your employees. That will not work. But that's kind of an example that, doesn't get off the ground. The tax rules address many complex structures where there are multiple businesses that are owned either by family members or other partners, overlapping ownership and relationships. So you always want to be confident that you are truly a solo, because if you're either not qualified to have a 401k and it's established, it's not a qualified plan. Even if you have a 401k, a document that says QRP on it, and if the plan is run in a way that's not compliant, and one of the big trip ups is finding out that it's not truly a solo plan because somewhere in some affiliated business there was an employee that should have been covered, the penalties and repercussions are quite severe. But assuming it's a true solo plan, it's a match made in heaven for mega backdoor Roth. Now, why isn't every owner-only business doing this? There's an answer on this slide, but it's definitely not the answer to the question because I don't think business owners are aware of this concern, and I'm not sure to what extent they should actually be concerned about it. So for tax nerds, I've got an answer for why maybe it shouldn't be done. It definitely can't be the reason why people aren't doing it. And historically, it doesn't seem to have been something that has, at least to date, something that the IRS has been focusing on. But there's something called its step transaction doctrine, which impacts all areas of tax. Very often we're presented with tax tools that are promoted by folks, and they'll point to even to a section of the tax code and say, hey, the tax code says don't do this. But guess what? We have a structure that can achieve the exact same thing without violating the letter of the law. So for that, the IRS has a whole slew of tools that fall under the rubric of substance over form, which means to say the IRS gets to look at a transaction and say, yeah, we see what you tried to do. You saw the tax code and you decided to structure your things in a way to sidestep the law, the letter of the law, but violates its substance. And so we're going to take your transaction. We're going to ignore, we're going to disregard the form of the transaction, the actual legal structure and steps that you took, and we're going to judge this transaction on its substance. And we're going to view it as a direct contradiction, something that's violating the code. And one of those is, one aspect of substance over form is step transaction. And a step transaction refers to when you take multiple steps to circuitously achieve a tax outcome that you could not achieve directly, because the tax code says don't do this. But if you break your transaction into multiple steps and take kind of a circuitous route, you can reach the same destination. That violates the step transaction doctrine. So a question for all Roth conversions, and this can apply even to backdoor Roth IRAs. If there are contribution limits to Roths, and there are phase outs. So essentially what the tax code said is, you cannot do this. You cannot make a direct Roth IRA contribution. And so what we're devising is saying, we're going to break this into two steps and get to exactly what the tax code does not allow for. Does that violate? Can the IRS come and assert that this violates the step transaction doctrine? And essentially what we've done is a Roth contribution that exceeds the limits. Might they assert that? Might they not? That is a question. This is a strategy that's executed fairly often. It has not been a concern to date. The folks that want to play conservative will wait a bit. They'll let the money season somewhat inside of the retirement account, perhaps invest it and accumulate some small amount of earnings on their after-tax contributions, and then do the conversion, pay a small amount of tax on the earnings that accumulated, but thereby, getting greater confidence that they're not violating the step transaction doctrine. Kavita, any questions? Anything that requires greater clarity?
Yes. So quick question here on behalf of the audience. I'm sure the audience has a lot of questions, but one of the things I get asked very often from my investors is, what qualifies me to set up a solo 401k? One of the things that I learned is that you have to have an active income business. But let's say a lot of my folks on the call have they're property managers essentially for their own rental properties. Does that really or truly qualify them to set up a solo 401k based on their them being property managers for their own properties?
Yeah, so that's another piece of misinformation that's been put out there and promoted. And without careful structuring, the answer is an unequivocal no. With some structuring, possibly. But what very often happens is when people understand the risks or the cost of structuring, and they understand and they're given the full information, the full understanding of the benefits of a qualified plan 401k versus IRA, more often than not, trying to bend over backwards to get qualified turns out not to be worth it. So just by virtue of managing your own rentals, absolutely not. And then with careful structuring, possibly, but it comes with additional cost and headache. So it's really important when you do these things is to understand that getting the piece of paper that says QRP on it or 401k without the support and guidance is almost something that folks are better off not getting. Now, to date, this has not attracted IRA scrutiny, right? Obviously, I think my concern is that we are headed to perhaps let's call it self-directed 2.0. It's going more and more mainstream. The abuses have become egregious as opposed to being aggressive. And that's when things begin to attract IRS scrutiny. So what tends to happen, you mentioned earlier in this discussion, what were those designations? CPCU, ARM, ACI. And I got those when I was working on captive insurance. I was working on it from a tax perspective. And you can just Google captive insurance, IRS enforcement, listed transaction, to get an idea of what happens. An industry kind of hums along, people using the tax code perhaps aggressively, but then it kind of catches on, folks emerge, promote it, and going beyond aggressive to abusive, and that's when the enforcement action steps up. So that's what's happened to conservation easements, to captive insurance, to what are called 412I plans. There's a whole graveyard of tax tools that were used and then were targeted by the IRS. So I think as self-directed accounts go more and more mainstream, compliance becomes more and more important. So a plan that is not qualified, that's the tax impact of having a plan that's not qualified can be absolutely devastating. So it wouldn't be wise to set up an account to achieve some sort of UBIT savings, potentially some sort of UDFI savings, at the risk of having a plan that's not qualified, either because it doesn't fit the tax profile or it's not operating in accordance with the rules. So the short version is, just by virtue of managing your own rentals, no. Can it be restructured? Possibly.
Okay, got it.
So then that's actually great for this slide that we've got here. So the mega backdoor Roth is another strategy, and that's why the world of qualified plans has far greater flexibility than the world of IRAs. But flexibility and freedom, the flip side of that, it's kind of the other side of the same coin, is the complexity and the compliance and doing it correctly. So it's the process of determining whether or not you should actually execute this is about determining which plan is right for you based on your profile, implementing that plan correctly, and then operating it correctly on an ongoing basis. So self-directed qualified retirement plans are not just kind of IRAs on steroids. They're a completely different animal with great tools, but at the same time, far greater compliance complexity. So how much time do we have for Q&A?
We have the next half hour. It was an an hour and a half scheduled, so we are good.
Okay. Let's do this.
All right, lots of questions here. Right. Okay, King asks, I have a pre-tax traditional IRA from my previous employer. Is there a way to avoid pro-rata rule?
Absolutely.
So can you tell us what pro-rata rule is?
Yes. So the pro-rata rule is as follows, and this is where it's most often encountered. So you roll over a prior employer 401k to a traditional IRA. And now you've got a very large traditional IRA balance. And you want to execute a backdoor Roth IRA. So you make your annual non-deductible contribution, right? You're phased out of the IRA, Roth IRA contributions. So you make your $6,500 contribution after tax to that traditional IRA. And now you'd like to convert it and you want to isolate, in the perfect world, you would isolate the after-tax money from the pre-tax money and only convert the portion that is after tax. Because on that conversion, there's no tax to be paid. It's after-tax money. Whereas the pre-tax money, if you do a conversion on that, you're just adding more income. That's going to be taxed at your marginal income tax rate. And so this is where we encounter the pro-rata rule, which says you cannot isolate and convert just the after-tax portion. Any money converted from traditional IRA to Roth IRA includes a proportional share of pre-tax and after-tax. So you can imagine you've rolled in $500,000 from your prior employer 401k. And now you've contributed $6,500. You've contributed that, a couple of $1,000 to after tax. If you convert $6,000, just about all of it is going to be taxable because your ratio of pre-tax to after-tax money in your traditional IRA is just overwhelmingly pre-tax. So the only way to convert all your after-tax money is to convert the entire IRA. And that would mean taking a $500,000 bump in income. So that is the pro-rata rule that can frustrate doing a backdoor Roth IRA. The way around that is to roll the pre-tax portion into a qualified plan. That is the way around that. Move it out of your IRAs and into a qualified plan, and this way you can isolate the IRA. King, that part, you can isolate the after-tax portion. King, does that answer your question?
So before we move ahead, Bernard, can you tell our viewers what are some of the things they can use to roles that they can use to set up a qualified plan? What would qualify them? What do you see investors being? So all of them are real estate investors on here, or most of them are. How do they qualify, or how do they qualify to set up a solo 401k or a QRP? And also, how does the spouse play into the mix? I know that even if you have a spouse, you can still set up a solo 401k. Can you address those two questions?
Yes. So it begins with having a trade or business, which theoretically can be anything, but can't be nothing. So it's not something that's nebulous. As I mentioned, there's lots of court. That's really the best thing we have to go with is what the courts have given us. But to simplify it, it's an ongoing activity engaged in with consistency to create profit. There are no hard and there are no bright line rules. So it can't just be say, oh, I am I'm managing my own rentals. It cannot be that you say, oh, that I'm going to be affiliate marketer for somebody. It has to be some sort of measure of consistency, right? Now, if this was scrutinized, what the IRS would look is, how much did you invest in it? How much time did you spend on it? How much activity was there? So they can't read your mind, so they look to facts and circumstances. Does this look like a business? And contrary to what may be out there, what I tend to see, and when people understand and have the full suite of information, it tends not to be worthwhile to bend over backwards because it never really materializes. And when you understand what the real upside and downside are, it tends not to make sense. Now, if we have somebody that says, oh, I wanted to start a business, I've been meaning for years to do this, but I just never got around to it. But I have a real business that I wanted to start. And this is just going to be the impetus to do it. That has a measure of realism to it. But people that say, I never really wanted to start a business. I don't want to do that. And I never had a business. I never intended to have a business, but now I want a QRP. It tends not to work. Because even if they say, oh yeah, I have a business, and they do the paperwork, there's the risk that they won't follow through, which tends to materialize. And then if you look back 3 years later, they roll their money into a plan and there's no trace of a business there. Or alternatively, if you'll have somebody that perhaps historically had some sort of business, but they stopped doing it, but it's something they can always kind of turn the switch back on, turn the faucet back on. And this provides the impetus that works. But for people that have never had and never want to have, and they're just kind of paying it lip service in order to adopt a 401k, it's probably not the prudent thing to do.
Right. But let's say I'm an engineer and I have a consultancy business that I consult part-time. That would be a real,
yes.
Right?
That's amazing. That's amazing. Assuming it's ongoing, absolutely. That is beautiful.
Yeah. Or maybe I'm a coach, I like coaching people. I know a few people on here are coaching, right, actively. So there are businesses and they don't have to be related to real estate or anything like that. It just has to be an active income business. Is that right?
Exactly. That's exactly it. One of the things that we go through with clients, obviously, is trying to explore all these possibilities and uncover them. And sometimes we do, sometimes we don't. But yes, consulting is great. Coaching is great. These are all active income businesses.
Okay. Getting back to the questions, Raj asks, you cannot contribute into a Roth when your income goes beyond certain limits. Is there a way out of this to continue contributions? I believe you answered it, but yeah.
Yeah. So this is what we've been addressing. It's either through the backdoor Roth IRA or 10xing that using the backdoor Roth QRP.
You skipped over UBIT. Okay, I think we might have to call Bernard in for a full UBIT discussion. Maybe we'll schedule that sometime. We don't want to get into UBIT today. So we'll skip that. In such an ask, in case of my demise, when the amount gets transferred to my heirs from a Roth IRA, does it become taxable for my heirs?
It does not, but they cannot leave it in there indefinitely. So while you can keep the money in there, you don't have any RMDs, your heirs will have to remove it. So it will move out of that account tax-free, but once it's out, whatever they do with it will be taxable. It will not be able to sit there. You can't kind of create this dynasty Roth IRA.
They can just pass it on to their heirs. Unlike a 1031 so far, anyway. Okay, Elizabeth asks, what sorts of financial instruments can be added to Roth like these? Can shares in private companies, LLCs, shares in funds? Yeah, I guess so, right? Anything really.
Yeah, just about everything can be done. Obviously, a lot of considerations on either prohibited transactions or UBIT. So some of the rules will say, hey, don't do this. Some of the rules will say, maybe there is a smarter way to do it. But these are all doable. But there are all sorts of either opportunities for pitfalls or opportunities to optimize the structure. So all doable, but you want to do it in the smartest way.
All right. Anand asks, what is an implant conversion?
Okay, implant conversion is moving money between the buckets. When you do that, you pay taxes. If there's any, and I think we're going to be addressing some of this is going to address some of the questions to come. So it's taking money from either the after-tax bucket or the pre-tax bucket and moving it to the Roth bucket. And to the extent that there is money in there that is pre-tax earnings, you get a 1099-R and you pay taxes on that. But that's what we're doing. We're converting it from pre-tax or after-tax to Roth.
Yeah, I think there's a follow-up question on that. It's the same question really. Does the 401k in-plan Roth conversion involve paying tax on the pre-tax amount?
So it absolutely does. There's a lot of nuance there in terms of isolating to an extent. There is opportunity to isolate, assuming the plan accounting is done right. So one of the things that, if you have a proper TPA in place, which corporate 401ks will have, the accounting is going to be good. In the solo space, accounting tends not to be that great unless you've been given the proper education and tools to do the correct accounting. So the amount of tax you'd have to pay will depend on how robust your accounting has been if you're using your solo QRP.
All right. Suresh asked, does executive savings plan qualify for Roth IRA conversion?
So executive savings plan is a bit of a nebulous term. There are all sorts of structures that are put in place for executives. Many of them are non-qualified. All sorts of incentives and golden handcuffs that are put in place. So for the most part, those will not fall in this category. But you can be looking at life insurance arrangement, the split dollar, and there are so many different possibilities out there. But this particular strategy is going to be limited to 401k, 403b, and 457.
Okay. Is there a dollar amount limit for Roth conversion per year?
Nope. No conversion limit, meaning there are going to be all sorts of limits that you're going to encounter based on your account balances and contribution limits. But theoretically, if you've got an account with millions of dollars in it, and the plan is structured to allow it, there's no limit on the conversion itself.
So you probably want to keep your tax brackets in mind when you do the conversion though, right?
Oh yes, absolutely.
And tax liability. Okay, Rao asks, if I do not have any business and no other earned income except my only company 401k, how do I do the backdoor Roth? So I guess we can't, right? You can't do the backdoor Roth unless you have a business. Is that right? So
on the company 401k itself, right, you'll have to know if you can roll the money out, right? As long as you're employed there. So you're to a grade, if the company plan doesn't allow it, your hands are probably tied. Obviously, you can do a backdoor Roth IRA.
But you can't do it with an old employer 401k, right? You can still do it.
Absolutely. You can roll that out and you can convert that. You can certainly convert that. You can roll that over to IRAs and do the conversion right there if you'd like. but to actually, be able to do that on an annual basis, that option probably won't exist.
Right. It could be like a one-time. So let's say you left an employer, you have a big 401k, you could roll that to a traditional rollover IRA and then convert that to a Roth.
Absolutely.
Can you take a piece of that and convert it to a Roth? Like you can choose how much dollars you want to take out of the traditional and convert to a Roth?
Yeah, absolutely. You don't have to, it's not an all or nothing deal. You just want to remain aware of that pro-rata rule again. Right. So if you want to, you can't isolate after tax amounts. It's going to come out of, so it's going to be taxable essentially.
Right. But let's say I had a $500,000 traditional IRA, which was my rollover IRA from a previous employer, but I can take 100K of it and convert it to a Roth.
Absolutely.
Pay the taxes on it, right?
Absolutely.
Okay. Got it. I hope that's clear. If it's not, feel free to ask the question again. Still not clear. If you're a regular employee without an implant conversion feature, and if you don't have a side business, it won't apply. No, it does. We just talked about it, right? Like it will apply maybe if you have an older, a rollover Roth from a previous employer. Is that right, Bernard?
Yes, I think we're all talking about different angles of it. So of course, if you have that ability to roll over, you'll be able to do it. And if not, as Cap says, it will not apply. And even if you have the side business, right, it may or may not apply because unless your side business is profitable enough for you to hit those limits, right? So just because somebody has a side business and has a QRP doesn't mean they can put $58,000 in there. The side business has to have adequate income to justify those contributions. So there are contribution limits. And yes, unfortunately, I do encounter people that were told, oh, set up this plan and you can contribute $58,000, and they just stick $58,000 in and their business had zero income. But yeah, I see all sorts of things. So it's not just about having the plan and having the business. It's about having the numbers flow the right way so that you can execute the strategy.
So you can, just to clarify for the audience and clarify for myself, you can roll over the dollars from an old employer plan, for example, into a solo that you just set up, but you can contribute to it actively except from if your business is generating income.
Exactly.
Yeah. So there's contributions and rollovers, two separate things.
Exactly.
Okay. I hope that's clear. Please feel free to ask questions if that wasn't clear. Okay, the questions are coming. I can't seem to get through to them. Murli says, currently for a pre-tax 19, okay, this is a lot of the same thing, I think. Pre-tax 19.5 can be put in a 401k. The remaining of 58k can be put in a post-tax 401k Roth. Can you read this question? It's kind of long.
Yeah. So I'll just try to answer it based on my understanding of it. So there are lots of plan limits. It's going to go beyond the scope of what we can discuss today. But there are a range of limits. Some limits apply at the plan level. Some limits apply at the employee level. So you can potentially contribute and max out 2 401k plans. But in no event can you have an annual addition to your 401k plan account that exceeds the applicable 415 limit. So the 58k, you can never get more than 58k into your plan. So the 19,500 does not get stacked. The 19,500 is within the 58k. So you can't stack those, and you can't keep do 58. Your limit will never exceed 58k to a particular plan.
So that's including both the plans. So let's say I have an active income business and I have a W-2 job with an employer. So if I contribute 19,500 to my W-2 employer plan, then I have 58 minus 19,500 to contribute to my solo.
No.
You have the entire 58 if your business is making it.
You have the entire 58. But there's no more employee contributions that can be done. So the 58 has to come strictly from profit share.
Got it.
Which is much harder to hit, right? So to hit that 58, your business is going to have, about 250,000 in
right. In which
income.
case you're probably doing that full time and not doing your W-2.
Exactly.
Okay, Anand asked, are there any tax consequences? I think we've covered this already. For in-plan Roth conversion of post-tax 401k contribution.
Yes, so which we spoke, taxes. Potentially, if there are earnings that are pre-tax that are included in that contribution, there can be tax. If it's so to the extent there's pre-tax money included in the contributions, there's going to be tax.
BJ asked, are employer contributions after tax 401k contributions?
And they are not after tax. They are pre-tax, but that you can still convert them. Right. So to clarify, maybe this is worth clarifying, right? Theoretically, if the plan allows it, pre-tax can also be contributed. But pre-tax money, it can hurt to convert that because you're going to pay taxes on all of that. The real appeal of this strategy is to be contributing after tax amounts. So there's no tax hit, right? So things that you have to think about is maybe on the 19,500, I do that pre-tax, and then on the balance 19,500 to 58, that's after tax. I couldn't get a tax deduction for that anyway. So let's just do it after tax and convert it. So I'm creating the Roth money, and I haven't given up any tax deductions.
Right. Okay. Arun asks, can single member LLC avail of this 401k? I guess he's talking about the solo. That's a little bit more complex.
But there's an easy answer to that. And I kind of want to answer it because it's something I've been encountering recently. Having a 401k plan and having a trade or business has nothing to do with having an LLC. So one of the other things I'm seeing is people are going to document sellers of QRP or 401k plans, and they're saying, set up a single member, set up an LLC, and then you can have a 401k plan. So these are actually the ones that are suggesting that are document sellers that do care a bit about compliance, but not about your compliance. They care more about their own compliance. So if you have a trade or business, that's a business activity. That is a business in the eyes of the IRS. An LLC is just a legal tool for liability, limiting liability. Having a business is not technically in any way related to creating a 401k plan. So if you've got business activity, great. If not, then not. Creating an LLC doesn't really change anything. In a way, it protects a document seller so that they can have plausible deniability. They can say, hey, yeah, we were justified in selling him this document, and we were entitled to believe that you were a good fit for a qualified plan because we see you had an LLC and you have an EIN, so we're entitled to assume that you have a business. But if it's just a shell, it's meaningless. And if there is a business activity as well, it doesn't really play a role.
Okay, this is interesting. Is there a good recommended software? I think I want that app that can track one's solo 401k, Roth, SEP IRA, and STIRA accounts, and what the basis of classification of the funds are inside one's 401k, the different accounts, pre-tax, after-tax, and Roth.
So I am not aware of any such software for the most part, because the real world of QRP and 401k is the world of TPAs, right? And these are third-party administrators that actually do all this, and there's software for them. For folks that have solo plans, there is no software for them. There's just not enough. Solo are not going to pay the thousands of dollars that this software costs to run it. Now, you can have a full-blown, a true TPA for your solo plan. And in fact, I would recommend it. But the way the 401k plan industry, for the most part, is structured in the solo space is you pay to buy a document, and then you're more or less, for at least from a true compliance perspective, you're kind of on your own. We do have spreadsheets that we create and provide to our clients and educate them on how to tracking it, but there's no kind of retail app or software. But maybe we should create it.
Yeah, that definitely sounds like a good idea. I know I would benefit from it. It's really hard to track. So what's the difference between an active and a passive income business? I think this is a good question to answer.
Yes. So a good rule of thumb is to think of the type of activity that would generate payroll tax. It's not the true definition. So if there's any real tax nerd on the call now, they may be saying, Bernard, you're getting it all wrong. It's not really dependent on FICA, FUTA, and SUTA tax. But as a good rule of thumb, it works. If it's a type of activity that's generating self-employment tax or payroll tax liability, it qualifies. If it doesn't, then it won't.
Okay, great. All right. I'm just, in the interest of time, maybe we should pick some questions. We are already running out of time. Let's see. You see anything interesting, feel free to pick. Okay, if a side business is generating income, how much income should I generate to contribute to a solo 401k?
Yes, so technically there's no limits. What is really important is ongoing activity to create income. The actual income is not technically important. But if it was ever challenged, right, when the IRS looks at something and says you have no income, that's something that makes them say, hey, this is not really a business, because nobody does something for 10 years without generating income. So income is not technically important, but it creates a better fact pattern.
Okay, I think this will kind of wrap up the last one. I have moved my old employer 401k to an IRA. Can I pay taxes on this and roll that to a Roth IRA?
Yes. Now, and I guess we'll wrap up with this. Yes. A key takeaway, the answer is absolutely yes. But should you do it? That is the question. So I get asked all the time, Bernard, I saw online that I can do this. Is that true? Can I do it? And sometimes the answer is yes. Sometimes the answer is no. But the most important thing, the real question is not can you do it? It's should you do it? And the information that people encounter online tends to be incomplete, usually innocently, because there's so much nuance and so complexity. And there's no blog post that can possibly account for all the factors. Occasionally, the information is, it may be not fully accurate by design. But the answer is you can, but the follow-up question is, should you? And there are a lot of considerations for that.
Awesome. Thank you so much. I think we are going to end the questions here. If you guys have any other questions, Bernard, would you be able to share your information? Do you have oh, there it is. It's still there. Okay, it's on there. You can reach Bernard on there. He'll be happy to answer any questions. He's very good at what he does, and clearly he knows a lot. And thank you so much for being here. And I hope you guys all have a great rest of the evening. Bernard, thank you so much for taking time out. I know we ran over on this. I appreciate you staying late and answering all the questions. Also, next week and our next 2 weeks from now, we'll have a webinar on making your passion your purpose. Please join us for the next webinar in 2 weeks on a Thursday at 7:30 p.m. I will be setting out invites, so keep on a lookout if you guys are interested. Thanks all for joining, and have a good evening. Thank you, Bernard.
Kavita, thank you for having me. It's been an honor and a pleasure.
Honor is mine. Thank you. Our pleasure is mine. Thank you. Have a good night, everyone. Hi, I'm Kavita Bartake. I hope you found this video useful, and if you did, please don't forget to subscribe to my channel so you can get notified of any future videos I upload. I plan to cover a lot of investor education on this channel, and I hope you'll stay with me for it. If you have any feedback on future content you'd like to see me cover, please drop me a note or a comment on my video. Thank you for watching, and thank you for supporting me.